Major funding for these broadcasts is made possible by grants from New York Community Bank, Capital One Bank, M&T Bank, Customers Bank, Chase Commercial Term Lending, Perfect Building Maintenance, Genova Burns, TerraCRG. Additional support is made possible by AKA Hotels Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Collins Building Services, Colliers International NYC, Connect One Bank, CPEX Real Estate Services, Cushman & Wakefield, DDG, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, Eastern Union Funding, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Friedman, Handler Real Estate Organization, HAP Investments, Hersha Hospitality, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, Meridian Capital Group, New Banks, Newmark Grubb Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rosewood Realty Group, SJP Properties, Sterling National Bank, Stonehenge Partners, TD Bank, The Continuum Company, The Moynihan Group, and these friends.
As we celebrate the 800th broadcast, we have to figure out where is 2016 with regard to investments and the real estate market in New York and the suburban areas. So I've assembled this group of dynamic, young real estate leaders, as I would call them, the next generation of real estate leaders, to provide their insight to see how 2016. My guests include Will Silverman, who is the managing director at Hodges, Ward's, Elliott; Amir Hasid, who is the co-founder and the chief investment officer at HAP Investments; Adam Hess, who is a partner at TerraCRG; Peter Von der Ray, who is the senior vice president at Marcus and Millichap; and last but not least, Jason Mair, who is the director of the New York office for Stan Johnson Company. So I have my crystal ball, I have my crystal apple, and I don't know. Will said to me, it's a little murky over here. So is it murky?
I don't think it's murky. I think what we've seen, Michael, is that for a while the market has been accelerating very obviously, but there's something in particular that's been happening as the market's accelerated, which is that it isn't so much that all property values have risen in lockstep. I think one of the things that's happened, and a guy named Matt Adele once pointed this out to me, is that when the market goes up, what's really happening is that the gap between the best and the worst is narrowing, and the worst starts to price like the best. And I think what we're starting to see is the separation of that. So the best stuff is still attracting attention and attracting good tenants and good buyers, but the stuff that was getting priced as though it was the best when it was mediocre or worse is now starting to separate again.
So here's the question. As I said, I have 4 investment people and I have 1 investor. How do you see it?
I think that the market is going to be, maybe it will take more time to make deals, but deals will happen in the right price, and I think that more money will come from different places in the world. Let's say Europe, that we can see that people are looking to invest here some more. So maybe it will take more time because it's also different money and different investors. They are not that aggressive as the New York market investors that are used to it, to the rhythm, but I think 2016 will be a good year.
Now, Adam brought up a comment before when we were in the green room that he had recently done a large multifamily deal at the end of the year, and the investors were not from Europe, they were not from the Middle East, they were investors from New York City.
Yeah, they're investors from New York City, and they owned a lot of other real estate around the country. And their basic take was, they had disposed of a lot of their assets in the rest of the country. And I think on the subject of the market, we take it for granted in New York City because our market has been so good from 2010 on. I mean, we've come back so much quicker than the rest of the world and the rest of the country. So I'm hearing people now, not just foreign investors, investors in the rest of the United States that are, the market's finally started to come back. They've been able to dispose of some of their assets without taking too much of a bath. And they're desperate to bring that money into New York City. So I hear all the time on all the different shows, foreign investors, foreign investors. You talk about the market. Everyone's very nervous about what's happening. Are we going to have a big slide down again because of what's happening in China or what's happening in the Middle East? And I think that's what you're saying, is that the more that stuff happens around the world, the more of a safe harbor it makes New York, and the more that's going to continue to drive our market. I don't know if people are going to keep paying for caps, but I think the market's going to stay a good volume.
Peter was saying, part of the situation, and I think the general concept was that people are taking longer to do a transaction. Part of it relates to governmental, VHCR, Rent Stabilization Board, other situations.
Yeah, well, people don't want to make a mistake right now. People don't want to make a mistake. The market's gone up for 5.5 or 6 years straight. And
Look, you can go write another book.
I know, it's time. It's actually time to, right? But, people don't want to make a mistake. I think there's just a general sense of, we're in a certain part of the cycle. And as you point out on there, we noticed that also this year, is that if you look back on 2015, the diversity of buyers that we did deals with, it was a much more diverse group than previous years. And we had people who were, big retail owners and developers coming in and making their first Manhattan purchase, office building guys, people who usually were just doing ground up development, who were looking to diversify their portfolios and add some cash flowing. And so not only is the group more diverse, but what's driving them is more diverse. And what's the motivation behind the investments themselves?
Now, part of motivation of investments is tax laws. And, one of the big things on the tax law is the 1031 tax-free exchange, matching a property over there. And that's a lot of your business comes that way, right? So how do you see it?
I think as we went into the second half of 2015, we started to catch a little bit of a headwind. We saw that the institutional REITs like American Realty Capital, Realty Income, and Inland had pulled back a lot. That affected our business where I would say we were down about 14%. Locally here in New York, again, the transaction volume was largely driven by the large family office, private investors, and they picked up a lot of the slack. And again, on a national level, we saw a little bit of a pullback. We were still able to, see a 14% growth overall, hitting around $3.5 billion in sales overall again. But the projection models where we were on pace in the beginning of 2015 put us at a higher level at the end of the year. I look at, going into 2016 as we're going to see a little bit of a spillover from 2015 into the first quarter. And depending on what litmus test I'm really going to use to look at 2016, there's a lot of factors. If I take technical analysis versus fundamental analysis,
I like napkin analysis.
Well, but again, napkin analysis, I think that interest rates does play a part, and, what's going on in the world does play a big part. So, there were events that happened in 2008 that brought us to a halt and caused a lot of damage. I think that those same outliers are still there. That same event can occur again. So when we talk about transactions taking a little bit longer, there's a reason for that. You can't afford to be wrong when you know that you're at the tail end.
And relating to that specifically is certain of the banks are saying to me, I was with a dynamic young president of a bank the other day, and he says, I'm not worried about the period 2 years. He says, I'm worried when somebody has taken out their money in a multifamily specifically. They've taken their money out, and it's 4 to 5 years. They're non-recourse. They don't have to worry. And fuel went up by that time. Insurance went up. Real estate taxes went up. And rents did not match this situation.
Yeah.
I'm worried about that. And I think that analogy example, and especially since you brought up 2008, is like in The Big Short. You go see The Big Short, and they say, people bought a building, then they refinanced it. It's the same problem in the taxi industry. The reason that we have a problem in the taxi industry, it's not that there's Uber or Lyft over there, it's that the people over-leverage the situation. The over-leveraging can have an effect on the investment sales market also.
Well, we've had basically the recovery itself has been all asset-based. That's what's happening in the stock market right now. It's overvalued, it's coming back. And a little bit, you're seeing this in the real estate market where people, I think, are looking and they're saying to themselves, I want some of the fundamentals underneath the assets to come back. That's probably what you're seeing in other parts of the country too.
Again, we're a flight to quality and safety. I mean, the single tenant net lease universe is backed by the credit of these major corporations, so they're not, really as exposed to the market fluctuations of, let's say, or regulations as this, the same way multifamily or development would be. So, with that,
cycles change. We were talking about TD reducing the size of their branches, Chase opening up branches, but a smaller situation, but. Let's look at a situation. I remember when I was doing some financing, let's say 15, 18 years ago, the favorite tenant, if you said the Gap or you said Banana Republic, that was fine. It was credit. There was everything over there. Or, go back even further, Sports Authority, Kmart, and all the rest. What happens? Some of these businesses aren't going to be around. There's a change. The world changes.
But Michael, there's two things in that. One is there's a changing nature of retail because there's a new category of retail store that hasn't previously existed, which is the brand experience store. Right? You've got stores now that exist solely for the purpose of reinforcing brands. You've got car dealerships doing it in the meatpacking district. You've got Samsung, Microsoft. You've also got stores where you can't walk out with anything. You've got stores like Warby Parker and Bonobos. So there's entirely new categories of stores that have emerged.
Okay.
But there's an entirely new categories of brand experience retail that didn't exist previously. So while some of those groups are contracting, you've also got a lot of tenants in the market that are just new tenants in existence, let alone in this market. So I think there have been some people there to pick up that slack.
You have investors from the Middle East, okay, and from Europe. Mm-hmm. When they come, when you do, as we would say, proverbially, a roadshow, it's a similar thing that they do when they're meeting with people. What do they ask you? What do they say?
So I agree with what you said before about investing in New York. They're asking for a less return because of the situations all over the world. So they look at New York as a safe market, even though we saw 2008, even though everyone knows that there are cycles in real estate and everything in life, but they believe in the power of New York because after 2008, if whoever came there saw that the market becoming very good very quickly. So now actually people believe more even in New York market. They want to invest more.
But, Adam brought up before, we were talking about Brooklyn multifamily apartments selling at $800 a unit, okay?
Yeah, $800,000.
$800,000 a unit. There's a question of what rents. Now, I do believe that millennium's coming into New York and people want to be here and everything's fine. If there's a slowdown in the economy, I'm not saying a recession, I'm just saying a slowdown. Somebody who's earning X dollars, who's a millennium, and they're paying for their share of an apartment, there's no more affordable apartments in New York City. It's a difficulty over there. And, certain people believe even when they buy something at $800,000 or $1 million, that they can reconfigure the apartment and get the rents up there and everything. But you have regulations, you have other things. That may have a little stymie effect on 2016.
Yeah, I mean, I agree with what you're saying. I think that, first of all, we have so many units coming onto the market right now. We have, I think you said, in
60,000. 60,000 residential. Rental.
In Brooklyn alone, we have, in 2015, 6,000 units coming onto the market. So, the shows about what's going to happen in 2016, the only thing that really keeps me up at night is that number 6,000. And then when I drive down Dean Street by Pacific Park to my office, and there's 353 units coming onto the market. So the absorption is how those apartments get absorbed is where it's all going to shake out. If they're absorbed well, I think that we can keep coasting around a little bit. If they're not absorbed, and we have a glut on the market, I mean, that can ripple over into multifamily.
So here's a question. I mean, Peter, you live in Westchester, correct?
In Connecticut.
Connecticut. You live in Connecticut. You've learned Connecticut, that's this side of the...
North.
North.
Ah, it's okay, I thought
North,
it's the
okay.
opposite. But no.
Okay, he lives in Brooklyn, okay? Two Brooklynites over here.
I'm not investing there, so I don't know.
But that's part of my question.
You're 5 years too late.
Okay, what about you are investing in Jersey City? There are people who are investing in Westchester today. People are investing in parts of Connecticut. Jersey has seen some recent activity because of the governors and other people. Where do you if you go to an investor and say, I want to go to Hoboken, you think they're going to understand Hoboken?
Part of them will look at it as part of New York, but I think the most important, and this is what we are saying, I'm hearing and saying, all of us here, it's taking more time to make a deal because you need to believe in your deal and to see that as a developer, I can say it, that it works both in rental and condo. And it's really hard to find rentals project today. Part of people will say that it's impossible. So if it's impossible, yeah, it's risky. Because then you're gambling, then you're speculating, you're thinking about the market, that it's the condo, $8,000, $100,000 or $1 million, it's still affordable. Who knows what will be in 2 years, 3 years?
Now, you're more involved in land sales and development, but we had a general comment before that land sales pricing are down. Certain people said they're down 10 to 20%. Is that what you...
I don't know that you can. I think it's probably too idiosyncratic to particular sites because the nature of the way that land is priced is so sensitive to condominium sellouts that the math can get a little bit screwy. So a site that's experiencing price contraction from $500 a foot will experience it differently than one at $1,000 a foot. But I think what everyone agrees on is that the air is thinner at the top. And there were a lot of transactions that were trading with one or two bidders ahead of the rest of the pack. And those couple bidders probably thought a year ago that they had a lot more company than they actually did. And I think what everyone is seeing is a lot of those people becoming hip to the nature of the competition or lack thereof. But that's not to say that there isn't still demand for very premium stuff. I spent the week in China late this fall, and all you heard when you went and we met with 25 different investors there, all they wanted to talk about was new development opportunities in New York City. So there's still a lot of demand for prime stuff, but it's got to be prime. To your point, people are saying, and to Peter's point earlier, people are saying, if I'm going to pay these prices at this moment in the market on what people believe to be the right-hand side of the curve, then I really need to be sure. Jason,
you do mostly, as you were saying before, credit, sales of credit properties, and I diluted it a little bit by giving the gap story.
Right.
Where do you see the market today? What's the preferred asset? Okay, are they very game on the CVSs, the pharmacies over there? Is it the banks? What's the type of assets that you see investors really interested in?
I would tell you the quickest pullback, I say the most recent pullback we've seen was in the flat leased Walgreens and CVS's. The pending Walgreens Rite Aid merger, immediately we saw a cap rate spike of 50 basis points. I mean, it was immediate. But again, in New York City, and again, you go internationally, everybody wants to buy New York, they want to develop. He goes to Asia, comes back, everybody says, what can you get me? I still want to build something. The retail in New York City is probably the hottest thing, and I would say globally.
Okay, so what about the retail? Not New York City. Let's say, New Jersey is not under retailed. New York City is under retailed. New Jersey retail. How do you see New Jersey retail?
I look at New Jersey as one gigantic retail corridor. I mean, Route 9, US 1, Route 17, Route 4, Route 202. I mean, Route 22. It's just a recycling.
Work for AAA or wait?
But, it is a recycling of retail, every 10 to 15 miles. And the best corners and the best locations. New York City, again, the best retail corners in the boroughs, the best corners, the best locations right outside of a subway stop. The demand for that type of product is always going to be insatiable. The larger New York families that are repositioning retail, that are developing retail, we do something called the tenant market expansion report, where we track the largest national tenants and look where they're going. And again, I was trying to make a point before about Starbucks and Chipotle coming to Kings Highway in Brooklyn. Their projections were at $700 a foot. Starbucks was when they came to Kings Highway. They're doing north of $2,200 a foot in sales. Chipotle again also underprojected their sales at about $550, and I believe that they crossed the $2,000 mark again in sales per square foot. So when the nationals start to wake up to the fact that Brooklyn is on fire, not just in development but in retail,
And all I wanted was the dollar stores, okay?
well, and again, they're expanding too in the boroughs. I mean, Deals, Dollar General have also expanded. We're seeing I'm sorry to say it, we're starting to see the death of mom and pop even in the strip centers.
That's interesting. Last week I took a walk on the day of New Year's Eve, and I walked down on First Avenue, and I passed across the street from Stuyvesant Town all of these mom and pops that existed. A mom and pop dress shop, a hardware store, and I'm saying to myself, they're not going to exist. No. I mean, they're not going to be able to pay the rents over there, the circumstance. Now, when you're selling, both of you, in the multifamily, with regard to the retail, how important is the retail component of the building?
I think that, maybe Peter will agree with me, but I think that kind of depends on the buyer. I mean, there's a lot of buyers that if the retail is good enough, their attitude is, you know what, we'll deal with the tenants, it's fine, we understand we're already in this rent stabilization game. Or there's buyers that are buying it purely for, they see the stability of the New York City rental market. People are always going to want to live there, and if the retail's good and I can get it to turn over. But I don't think there's any one approach of go in and get the retail out.
Yeah, or maybe you can look at it as the percentage of the income. So if the retail is up to 40% of the income, 35%,
then it's a different world.
Then you start to change the complexion of the buyer a little bit. And but as long as you're below that amount, it's more widely accepted.
One area, and I noticed a sales pitch that came over the internet yesterday from somebody. This is a to-be-built building that was on 23rd Street that somebody was already pre-selling. They had hired an investment broker to sell the retail component even before the building was constructed. Are you seeing that, or are you involved with
it?
Yeah,
that's not an uncommon trend. I think we've seen that for some time, because also it's just a way to stop the clock ticking on your money.
Sure, it's going to save your construction.
And I think your lender likes to see you doing that and likes to see you taking that money. And there's not that much of a gap between the price you would get. It's not like the retail investor needs to see the finished product in order to understand it, particularly if it's already been leased.
No, I'm saying this was not leased.
Even so, if you're at a strong enough location, I think people are comfortable with understanding where the underwriting is.
Amir?
I agree with you. We just did it in 121st and 3rd Avenue. We are now developing, but we sold the retail.
How much retail was there? How many square feet?
It's 12,500.
And what type of tenant do you think?
Supermarket. I sold it to a supermarket, and then I got the fresh bonus. So I got 2 more floors, and I secured part of the deal, and I know what is my outcome already. So in this market, in these days, you have to take it. This is the thing that you need to be more creative about.
So you're basically saying, which relates to the comments over here, there's a necessity to be more creative, a necessity to do a little more due diligence. We have the government control and other situations over there. Now, here's a question. A number of years, let's go back to pre-2008 when you were all in the business in a different market. Were you here?
In a different place.
No, you were in a different place.
Exactly.
Okay, but at that time, the private equity funds, and I was with one of them, all we wanted was multifamily apartments, okay? And then what happened was everybody said that the bad private equity funds were trying to get rid of the tenants, like Stuytown, which was now recently sold, okay? And as I told someone, I knew it was sold. They couldn't care. It was the air rights and all the rest. Do you see the private equity companies coming to you, wanting to once again buy multifamily?
Well, back then I'd send them a building and we'd have a discussion, say, what'd you think? And they'd say, you know what, this building's got too many free market tenants. Send me something with more stabilized. And now I can send them the same building and they'll say, you know what, this building has too many stabilized tenants. Send me something with more free market in it.
Well, what I've seen is we recently marketed a 1,000-unit portfolio in the Bronx. And what was interesting was a lot of the big opportunity fund and value add names that have not been in that business before, neither this cycle nor a prior one, were kind of coming up and kicking the tires and really wanting to dig deep and understanding that market. And it's an interesting game they're playing, because what some of them are saying is, instead of engaging in this parlor game of like chasing the gentrification along the L train as it goes further east, they want to chase the other side of it, which is where are the people being gentrified out going and looking for affordable apartments, and that's the Bronx. And a lot of it's like the old joke of in a gold rush, you want to be the guy selling shovels, not panning for gold. And it's sort of that kind of trade, right? And so we're starting to see a lot of them start to look at it, but it's not so much about is it rent regulated or free market? Because the reality, especially in the Bronx, is that so many of these tenants are effectively free market because their rent is below what you could legally charge anyway. But it's about there being a really compelling investment thesis that feels a little bit contrarian right now. And I think you are going to see many of them returning to that sector.
In Brooklyn, for the last couple of years, me and my partner Ofer Cohen, we've been meeting with the hedge funds, the institutional players for 3 or 4 years now. As soon as the lights went back on in the market, the banks turned the spigot back on, the hedge funds, the institutional players, they're in our office. And a couple of years ago, they were only looking at the real prime sort of Brooklyn neighborhoods, Park Slope, downtown Brooklyn, Carroll, Cobble, Borum, that area. Now, I think the sea change has been they're coming in, and you're hearing these guys say Bushwick, and you're hearing them say Prospect Lefferts Gardens, and David Kramer Hudson Companies has a big project over there. So I think that's when you really
are they saying Coney Island in East New York?
I have not heard Coney Island in East New York yet, but it's just a matter of time. It's going to get there. So, but I think that's the sea change, is that they're coming in and they're looking at all of Brooklyn now. And I know this is probably true in the parts of upper Manhattan that people didn't used to look at. Washington Heights, that these guys are looking there now and they want to buy and they want to be in on multifamily. Absolutely.
So as I look at the apple, I say, I'm going to keep it on the positive side. I'm not going to turn it over. And I think 2016 looks pretty bright. There are circumstances like China and other places that have an effect on all the world. But, we have to see what happens in the future. And I think that hopefully, as I celebrate my 800, maybe when I do my 850th, you'll come back and we'll talk again. I'd like to thank Mr. Will Silverman, Amir Hasid, Adam Hess, Peter Vonderay, and Jason Mair. And I'll see you next week, and thank you for being here today.